Tonight on Market Call, David Burrows will be on the show. He's President, Chief Investment Strategist at Barometer Capital Management, taking your calls, emails, and tweets on North American large cap companies. Hello, I'm Catherine Murray. Welcome to Market Call tonight. You can call us toll-free at 1-855-326-6266. You can also send us an email to marketcall@bnn.ca, or you can tweet us at Market Call. And if you want to get to the front of the line with questions for your favorite guests, you can get on the Market Call Fast Track. That's with a video question. Film a quick question on your smartphone or your tablet. Tag us in your post. Send us an email with the clips. Be sure to put video questions in the subject line. Your questions can be answered by one of our guests during one of our shows. David, good to be with you tonight. Thanks for coming in.
Great to be here.
Let's talk a little bit about your assessment of this continuation of the Trump rally. I think a lot of people maybe looked at it for the first 2 days and it was okay, but now they're really almost having to believe it. Do you believe it?
Well, look, at Barometer, I run some models that track where money is getting put to work. And from June until November, there was very clear themes leading into the election. Sectors that were outperforming on a relative basis that were all economically sensitive sectors. And while the positioning in the market, investors were very, very defensively positioned coming into the election, the signals were there. And what happened is the election took place and those themes just took off. So I think that the positioning was so defensive and people were so cautious going in that they ignored what was happening in the market and some of the economic changes that were taking place, and it's becoming very clear now.
So David, what specifically though are you referring to? Because I think, I could have people up here on my 2 to 4 o'clock show and they can tell me all the 10 things that are negative, and then somebody else can give me all the 10 things that are positive, and the market kind of figures it out somewhere in between.
Right. When markets are finished correcting, people have had lots of opportunity to sell based on all of the things that are out there in the market. And then the market reacts one way or the other. And if you look at what happened from June until November, the cyclical sectors of the market had very clear relative price performance. So going into the election, what was leading? Semiconductors, financials, materials, technology, and industrials, okay? Those sectors don't lead the market if we're about to head into a big problem, right? Those are very clear indicators, and those sectors broke out very quickly to new highs. Big parts of the market were also showing relative performance versus the S&P, like small and mid-cap stocks. So there was a very clear message from the market, and I think that people spend a lot of time thinking about what they think should happen based on all of the sum of all the things they read about. But I think the message is in the market. When you track what's actually happening, there's sometimes a very clear message.
So how were you positioned, though, before and after? Because when I do interview one of your colleagues, Dan Avidor, I believe that your approach was barbelled. You were prepared for if the markets moved higher, but you also wanted to have some defensiveness as well, correct?
So we came into the election fully invested. We actually have had several conversations since February that we felt February was a significant low in the market, and that once the market made new highs in June, we just simply consolidated between then and November. So we came in fully invested, and everything really has taken off since then. So we had our biggest weights were financials, industrials, materials, and technology. That positioning hasn't changed since then. Now, we own high-quality companies. We don't buy junk. We own companies that are technically sound. Anything that had broken down technically was not in the portfolio. But it's amazing how the things that were leading coming in have led coming out. And, portfolios have moved up like 7 and 10% in the last 2 weeks.
David, maybe give us an indication in terms of why you do use and look at technicals. There's a lot of money managers, if you go back 10 years ago, a lot of money managers, fundamental only managers, would never admit to using technical analysis, let alone use it. But that's definitely changed. There's too much market momentum. They have to use it, but they might not use it all the time. You guys seem to really incorporate this into your process. I
think you need all the tools. You need to do deep fundamental work to understand the companies you're investing in, but you also have to understand what the market can tell you. So, over a really long period of time, like 20 years, I think we've had about a half the volatility of the market with all of and plus the return. And there's times to play defense and there's times to play offense. The difficult part is that after you've been through a long, difficult patch in the market, people have a mentality which is, I just have to be too careful. And I would say we are at one of those moments when it's time actually to put the pedal down a little bit. I think the next 2 years are likely to be very strong. Fundamentally, the picture is there. Economic data is getting better, earnings data is getting better. Stocks are cheap relative to other assets. But the technical piece is important. It's important to know what to buy, and more importantly, to know what to sell.
What do you
right?
want to be selling right now?
So, look, since June, the bond proxies, things that act like bonds, have been relatively weakening, right? And sadly, that was the most crowded part of the market. That's where people were most focused. You know, you've had a 30-year bull market in bonds, which have given people a lot of confidence, even though interest rates this summer were at 5,000-year lows, right? So I think you have to be very careful with that part of the market. I don't think interest rates are going up in a hurry, but I do think we've turned the corner on a secular basis, and that likely you'll see 10 years of rising interest rates. And so things that get hurt by that, like utilities and telcos and REITs and so on, are likely to underperform. And more economically sensitive groups are likely to outperform, especially the financials, which benefit in that world.
All right, we're going to be back with David Burrows. He is President and Chief Investment Strategist of Barometer Capital Management, answering questions about North American large cap companies. You can call us toll free at 1-855-326-6266.